Hi, everyone. Welcome back to another episode of Ask an Actuary. Joining me today is Andrew Taggart, a consulting actuary here at Odyssey Advisors, to chat about cash balance plan. So, Andrew, what is a cash balance plan?
Well, a cash balance plan is a retirement plan that companies offer their employees. It's a type of defined benefit plan, more commonly referred to as a pension plan. And while a cash balance benefit is commonly shown as a lump sum, referred to usually as a hypothetical account balance, because it's a defined benefit plan, the underlying benefit is actually an annuity.
And talking about the hypothetical account balance, how is that calculated?
So each year, the hypothetical account balance is updated by adding two things, an interest credit and a pay credit. And you add that to the previous year's balance. The interest credit is determined using a rate that's set by the plan. It can be a fixed percentage like 4 or 5%, or it can be linked to like an index rate, like a 30-year treasury yield. Most of our plans usually use either a 4 or 5% rate. So the pay credit is the other piece, and that amount accrues during the year and can either be a flat dollar amount, like some say like $5,000, or more commonly it's tied to your pay. It's a percentage of pay, like 3% or 50% or even up to 100%.
And what makes a defined benefit plan different than a defined contribution or 401k plan?
Yeah, so a 401k plan that people have heard about, that is a defined contribution plan. That's where each individual person has their own account and they contribute to that account, and sometimes the employer can contribute as well, and that's based on a plan formula. The participants typically choose how they invest their own money in those types of plans, and the final benefit that you get can change wildly based on how the investment performance does. In contrast, a defined benefit plan guarantees a specific benefit that's defined by the plan, and that amount is based on a plan formula with the necessary contributions to get you to that benefit changing based on the investment performance of the plan. With cash balance plans, they maintain those hypothetical account balances for each of the participants individually, but the actual money is pooled together in one fund, and that's managed by the plan fiduciary who then invests it. The primary benefit of a cash balance plan is an annuity, and that's calculated using that hypothetical account balance. However, many cash balance plans also offer an option to receive a lump sum equal to that balance, that hypothetical account balance.
And to wrap things up, could you talk about how cash balance plans are becoming more popular now?
Yeah, so cash balance plans are they're the most popular type of new pension plan nowadays, and it's usually used as another form of tax mitigation in your normal plan of mitigating your taxes. So usually they're tied to a 401k plan and a profit sharing plan, and they add even more tax savings just on top of those. So it's usually for just the main focus is on the few higher income individuals in the company. And in the right scenario, a cash balance plan can add over $100,000 of pre-tax dollars to your retirement portfolio. So if this money is taken as a lump sum, it can be rolled over into an IRA and deferred later into retirement as the participant sees fit.
Thanks, Andrew, for joining us and breaking that all down today. For our viewers, if you have any questions or topics that you'd like us to cover in future episodes, be sure to leave us a comment below or drop us a message. Thanks for watching, and we'll see you next time.